Now we're going to go over the addenda that is typically attached on any sales contract. I have the home inspection and radon testing addendum, conventional, VA, and FHA financing addendums. Starting with the home inspection and radon contingency addendum. Paragraph 1 stipulates in subparagraph A that the contract is contingent until 9 p.m. X number of days after the date of ratification in the contract upon an inspection by a licensed, professional, insured home inspector at the buyer's discretion and expense. That doesn't mean Uncle Willie gets to come in and do it, or my boyfriend's father or somebody like that. It means a licensed, professional, insured home inspector comes in to do that. Sellers acknowledging by signing this that they will have all the utilities in service. If for whatever reason they're not in service when the time comes, that next paragraph goes to a later date so that the inspection can be done while the utilities are in service. Always good to call the seller's agent and make sure that the utilities are on. Or if you're showing the property and they're not on, make them aware that they need to be on for the inspection. If the results are unsatisfactory to the buyer, if they do the inspection and results are unsatisfactory to the buyer, they can either A, send a notice to the seller voiding the contract. They have to include a copy of the home inspection report, but they can send a notice voiding the contract. They do not have to give the seller the option to make any repairs or any changes. The majority of the time, they deliver notice requesting X number of repairs be made. They also have to include the entire copy of the inspection report, not just one or two of the pages. And they need to include a written addendum listing any specific deficiencies that they would like the buyer to correct. If for whatever reason the buyer fails to get an inspection, if they fail to deliver a copy of the report to the seller, or if they fail to deliver an inspection addendum or notice voiding the contract, then they lose the benefits of the contingency and the contract remains in full force and effect. Subparagraph B talks about the negotiation period. So we deliver to them an addendum with requested repairs, then there's X number of days for the buyer and seller to negotiate some sort of middle ground. If either the seller can just say, yes, we'll make the repairs, or they can say, no, we're not, or they can say, we'll do this and not that. 9 times out of 10, this is used by the seller to get estimates. They don't know what some of the things will cost. They may be willing to do it, but they're not going to do it without knowing what it costs. So there might need to be some flexibility in there. At the end of the negotiation period, though, it becomes a buyer's election period. And that buyer's election period is where the buyer can elect not to proceed with the contract. They can elect to take whatever the last negotiation was, or they can just walk away from the deal. And that's it. So long story short is if you do nothing, you lose your chance. And that's the important thing to acknowledge in that. Radon testing. The radon testing, very similar to the home inspection, pretty straightforward. There's X number of days to have it completed, and you have to have a test done by a radon professional certified by the National Radon Safety Board or the National Radon Proficiency Program. So, if the home inspector says, yeah, I can place those tests, it needs to be done by somebody that has those certifications and uses the certified EPA approval methods. Again, the seller has to have all utilities in service, and the seller, there's testing guidelines that the seller needs to be made aware of. And it's done in this addendum, so we go over it. You can't depend on the listing agent, so it's always good to notify them at least 12 hours prior to the placement of the test. All windows must remain shut. Exterior doors should only be used for normal ingress and egress and not left open. Whole house exhaust fans or smaller fans near the testing device must not be used. The radon professional asks the seller to indemnify that none of those things have happened. There'll be a form that they'll have to sign. If, however, they do, then the last paragraph there talks about if a test is voided because the seller has left the windows or the doors open or not taken the care that they're being asked to provide, then the seller shall pay for the new test. And that's right there in the contract. Had arguments over that in the past, so just to let you know, that's where it stands on there. In the event that there are radon levels that exceed the EPA guidelines, then we're obligated to deliver a copy of the radon inspection report, along with the request that they remediate the radon and that they retest to ensure that it's below those levels. We have to provide them, as I said, an entire copy of the report. We can also just deliver to them notice voiding the contract. We don't have to give them the right to remediate. Never have I had that happen, but it is an option. Again, if for whatever reason the buyer fails to get an inspection, fails to deliver a copy of the report to the seller, or an addendum or notice voiding the contract, then this contingency automatically expires. Even though they automatically expire, both this one and the home inspection, that's not how we do it. We want to have it in writing. We want to have the signatures on a piece of paper removing the home inspection. Again, there's a negotiation period. It's something that on radon, I think negotiation is foolish, because for the seller, it becomes a disclosable defect if they lose this buyer and that buyer walks away. But they still have X number of days to negotiate. I usually put 1 day in there. That's so they can go out and get an estimate. We have somebody good that can do it probably right around the $850 mark, maybe $900, maybe $800, depending upon how the installation is or where it can be in the house. So the radon and the home inspection are pretty darn similar. There's separate financing addendums for the three major types, or the three more typical types of financing: conventional financing, VA, and FHA. I'm going to start with the conventional because that's the basic, and then what I will do, because a lot of the terms are similar, I'll simply point out the differences between the other ones. On the conventional financing addendum, we have to check off that the buyer will obtain or assume a fixed or an adjustable rate loan amortized over X number of years at an interest rate not to exceed. So it doesn't have to be the exact interest rate, but it needs to be an interest rate not to exceed per year. If there is a second trust, we put the same kind of terms in there. And again, when it says obtain, that means getting a new loan. When it says assume, that means assuming somebody else's loan. That's a rare thing in today's market, but 20 years ago, it was a big deal. You had to know how to do that. Again, right now, most people are getting a fixed rate loans. That's probably what you're going to see. But adjustable rates, they were all the rage, and they may be all the rage again at some point in time. Paragraph 2 talks about the financing contingency shall not apply to any alternative financing. That means that if they change the financing terms, so if the buyer elects to get a different type of loan or change the terms, anything including the down payment amount financed, etc., the financing contingency does not apply. They have voided the financing contingency. They can substitute alternative financing, however, if they obtain the seller's written consent and execute a new financing addendum. That's the key. We want to discourage buyers from jumping around and shopping once they get a house. They need to have that handled before they get into writing an offer, before they get into being out there looking. But if they do that, and sometimes it can't be helped, they can't just switch off. To retain that protection, we need to fill out the appropriate financing addendum for them and get that re-signed. If they fail to obtain that without the seller's written consent, buyer shall waive the protection of the financing contingency. That's a big thing. Buyer does not, they can substitute a lender, they can change lenders and not change the term of the contract, and that's not a problem. And as long as there's no additional expense or the settlement is not delayed. Paragraph 3 and paragraph 4 work together. One says financing contingency with automatic extension. The other says financing contingency with automatic expiration. What that means is, in paragraph A, the contract is contingent upon buyer delivering to seller by 9 p.m. blank number of days after the date of ratification a written conditional commitment for the specified financing. We get a pre-approval before we're taking them out, but everything has to be compiled and rechecked and formal loan approval issue. It can be conditional, and a conditional commitment means that you're approved as long as you provide us a or pay off your car, or provide us a bank statement, something like that. That can still do it. There's a date that's specified in there. Usually it's at least 21 days to give time for the appraisal. If at the end of, let's say, 21 days, they are not able to provide that, the lender can't, there's an automatic extension, and it just automatically goes day to day, all the way up through and including settlement. However, the seller can turn around and send notice saying, we're voiding the contract, and then the buyers only have 72 hours to remove that contingency officially. They have to do it through the lender. Once that is done, the financing contingency is removed. If they give notice and they say it has to be done within 3 days and there's just no action taken, again, that contingency is deemed to be voided. So if you're out of town at the beach and notice is given and nobody notifies you, you get back from the beach and find out that they've delivered notice, we lose that protection. The buyer can void this contract provided that before the satisfaction or removal of this contingency, they get a written rejection from the lender. However, if they get a written rejection and they're rejected for the loan because they went out and bought $20,000 worth of furniture, which is a real story, went out and they get rejected for the loan, they don't automatically, that doesn't mean they're not in default. They can't have changed their financial status since the time they wrote the contract and the time they get there. They couldn't have done anything willfully. So they can't go out and do that as a means to get out of a contract. And if they do that and unknowingly don't qualify, they lose the protection of that contingency. Buyer may void this contract by delivering to seller prior to satisfaction or expiration a written rejection from the lender. So that's what they would have to have. Appraisal contingency. The contract is contingent or is not contingent upon an appraisal. There's a box to check in paragraph 5. Again, the contract is contingent for X number of days. It flat out says minimum of 21 days, and sometimes it can be sooner, but usually we have that in there. If neither of those boxes is checked, it automatically follows in line with the financing contingency time frame that's in there. They have to, by the time of that deadline, deliver notice that the appraisal is equal to the sales price and this contingency is satisfied, or buyer elects to proceed with the consummation of this contract without regard to the appraisal and this contingency is removed. If that's the case, buyer's going to need to make that difference up in cash. If the appraisal is equal to or greater than the sales price, the buyer can still elect not to proceed with this contract if it does not satisfy the lender's requirements, if the appraisal does not allow for specified financing, or the bank deems that it's improper collateral. So the appraisal's not the end of all. Never have I had that situation occur. However, that's what that paragraph says, so I have to note it. If the appraisal comes in low, first the seller has the option to lower the price to the appraised value. If they elect not to, the buyer can make up the difference in cash, but they can't use it with borrowed funds. They have to make up the difference in cash. That happens some of the time. The vast majority of the time, there's negotiation and they reach some sort of middle ground. If it's a $10,000 low appraisal, buyer brings $5,000 more to the table, and the seller lowers the price by $5,000 and they come to an acceptable number. In the event that they don't, the contract can be voided. It is notice from the buyer that has to do that, though. It doesn't just happen if you don't reach agreement. There's 3 days. If the buyer does not void the contract within 3 days following the delivery of the seller's notice, this appraisal contingency removed and the contract will remain in full force and effect. So it's not something to dilly-dally on. It's got to be dealt with quick. If it comes in low, we send them a copy of the appraisal. We send them an addendum asking them to lower the price. At that point, any negotiation occurs. If it hasn't been straightened out in 3 days, they either have to deliver to us a release or they lose the benefit, the protection of that. Paragraph 6, lender required repairs. It's a rarity that comes up, but it does come up. I had it happen a year ago where the appraiser comes out and they deemed that we needed to have railings on the stairs because they were more than 3 steps high, and we had to put railings on the stairs. There were stairs coming out of a garage, and they just wanted that. I've had that happen with railings on decks. I've had it happen with chimneys that are leaning away from the house. Usually it only happens on homes that are in disrepair or obvious neglect, but it does happen. What that means is the appraiser comes out to the house, they look, and they say, yes, we'll loan the money on the house, however, we want these railings put on, or we want the door fixed so that it actually shuts and doesn't let rain blow in, that type of thing. If they come back with that kind of request, the seller is not obligated to do that. They are given 5 days to decide whether or not they're going to do it. If they elect not to do it, then the buyer has the option of saying, shoot, I want the house, I'll put the railings on the steps. The buyer has 5 days to decide. If they don't, then the appraisal did not come in and this contract becomes void. On a VA contract, on a VA contingency addendum, all of the terms are the same, except it states that the buyer will pay upfront and monthly mortgage insurance premiums as required by the lender. Buyer pays the VA funding fee as required by VA regulations. Subject to lender's approval, buyer reserves the right to finance the VA funding fee, in which case the amount shall be added to the loan amount. So that's a different thing. That's the VA funding fee. Can't give you a specific amount on that because it depends on which type of situation, whether it's the first time or the second time that they have used their VA funding fee. But that's all stuff to discuss with the lender up front, but that's a difference on the addendum. They also have in there the assumption fee. If a VA loan is an assumable loan, it's assumable with qualification or without qualification. It can be done either way. Haven't done assumptions in many years now, but with today's low interest rates, when interest rates go up in the future, that's going to be a valuable tool. And I did a lot of them, a whole lot of them back in the day. I mean, it was really the only way to survive in the market at that point in time. So you don't have to waste too much energy on there, but that simply talks about if it is an assumption, that the buyer will or will not obtain a release of the seller's liability to the government, or will or will not obtain substitution of the seller's VA entitlement. Seller has a VA entitlement, they can let that loan be assumed, and if they request their entitlement back, then the buyer has to qualify for that. If they don't, then the buyer can just assume it, and then on down the road for that vet. But he can't use, or she can't use, that VA loan again. There's really nothing that's different till we get back to the appraisal part on there, and it says it is expressly agreed that notwithstanding any provisions of this contract, buyer shall not incur any penalty by forfeiture of earnest money or otherwise be obligated to purchase this property if the contract purchase price or cost exceeds the reasonable value of the property established by a Department of Veteran Affairs. Buyer shall, however, have the privilege and option to proceed with the consummation of this contract without regard to the amount of reasonable value established by the Department of Veteran Affairs. They refer to it, the value being established by the Department of Veteran Affairs, because they have their own appraisers. That's a big difference. They have their own appraisers, they have their own appraisal guidelines. It's different than a conventional appraisal. So you have to be aware of that when you're writing a VA contract, because there's a limited number of these guys out there, and in a busy market, you know, they're busy. You know, you've got to get in line. They don't have them on staff at the lenders like they did back in the day. So you can sometimes have a financing contingency of 21 days, and it's not done for 30 days, and there's nothing anybody can do about it. It just becomes one of those problematic things. So it's just something to be aware of. The other thing is they do have their own guidelines in that. So it's just done a little differently. Some say they're a little more strict, and rightfully so. The veteran is getting in there with no money down. It doesn't have that 5, 10, or 25% or 20% down that a conventional loan offers. Lastly, on there in the contract, we have a wood boring insect or wood destroying insect clause. On a VA loan, it's included in the financing contingency because what they're saying is fences and outbuildings shall be included in the inspection and certification, and seller shall pay for any wood destroying insect inspection required. Seller paying for it is not anything that's different than the contract, but the fact that they're making the loan contingent on it and that they are now including fences and outbuildings. A lot of times, you know, people have an outbuilding, they've got their firewood stacked up against it, and that's termite heaven. So it's a high likelihood, or it's a higher likelihood, that you're going to find termites in the corner of the lot with the wood piled up against the wooden shed than you're going to have up against the house. So something to be aware of. But as far as affecting our buyer, it doesn't. It's simply something that the seller is going to have to take care of, because it says right in this paragraph, seller shall pay for any wood destroying insect inspection required under this contract or lender. Now let me come back to that. That means that the seller pays for the termite inspection. We don't select who's handling that for our buyer. FHA differences on that is it says buyer shall pay upfront and monthly mortgage insurance premiums, MIP, as required by the FHA regulation. Subject to the lender's approval, buyer reserves the right to finance any upfront MIP, in which event such amount shall be added to the loan amount. Again, something to discuss with the lender. They've got the same information in there as far as an assumption, because the only difference is they don't have it in there about getting your eligibility back, your VA eligibility, because there is no VA eligibility for an FHA loan. Paragraph 3, FHA Required Notice. Buyer acknowledges receipt of HUD's form, blah, 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 entitled, "For your protection, get a home inspection." That it's a simple form. It becomes part of the contract when you have an FHA loan. So you need to make sure you pull that form, and it just says, "For your protection, get a home inspection." They don't trust us to tell our own clients that, which is wrong. Appraisal provisions, it's different there. They have what's known as the FHA amendatory clause, and that amendatory clause stipulates that the property must appraise for the amount that it is in the contract. It has the same kind of contingency negotiations in the back, but there's a dollar amount that goes into this paragraph, and it is the same. So if you encounter on an FHA contract, seller changes the front of the contract and raises the price from $400 to $410, has to be changed back here in this form as well. Otherwise, you're going to wind up having to come back and do it, and it's not good. You might as well just get it all done at once. And it says here, right in there, the dollar amount to be inserted in the amendatory clause is the purchase price as stated in this contract. Everything else is the same. One difference on the wood destroying insect. Again, they go back. Here it is in the VA. It says seller shall pay for any wood destroying insect inspection. On the FHA, it does not. It just says fences and outbuildings shall be included in the inspection and clarification. There is, on the very last, paragraph 9, on an FHA loan, there's a certification. And this is something that, as agents, we have to sign. Again, so when we're writing a conventional offer, a VA offer, there's nothing that we have to sign. On FHA, there is. So you don't want to overlook that, because although your signature is below the line, and we've discussed that line, it's still part of the contract and has to be signed. They will kick that back, and it becomes, they find it 5 days before settlement that's missing, and somebody's on vacation, and it becomes a problem. But all that signature says is they're stating that everything in this contract is true to the best of your knowledge, and any other agreements entered into between the parties with respect to the purchase and sale of the property are fully disclosed and are not attached. In other words, there's nothing going on under the table. There's no cash change in hands, there's no kickbacks, there's nothing, which is why they want our signatures as well.